when I was first invited to be on a panel simply called Tokens, I thought, considering the way in which who usually gets invited and not invited to many conferences seems sort of strangely direct and even refreshing. But I guess I realized quickly that wasn't the kind of tokenism that was meant for this particular panel. I did though there's, with this particular invitation, it became clear that the second set of informal remarks that I might give would be one that would speak either directly address blockchain topics or either perversely avoid them at all costs. And so I suppose I'm going to do a little bit of both, with again a sort of sequence of more work in progress informal talks, which we'll just call ZZ Top and ZZ Bottom. As I mentioned just a few moments ago, the contemporary figure of blockchain serves as a kind, at least at this point, as a kind of Rorschach ink blot into which different people see different things, hopes and nightmares alike, perceiving and projecting a diverse and contradictory set of notions about its potential and practical impacts, both near and far. And in this, economics enters, of course, then from gold standards to carbon pricing to the energy bill for Bitcoin miners, we're quickly confronted with fundamental questions of how matter and energy may contain, cohere, represent, guarantee, or exchange one another as value. That is, with blockchains, we may, in theory, induce currencies that refer to energy expenditure, that refer to the energy expenditure necessary to calculate them into existence. And to the extent that they are provisionally programmable, we have currencies that defer their apparent lack of defer their apparent lack of materiality into the hardware instead of into the token itself. Which is perhaps why, one of the reasons why blockchains have drawn so much interest in the formal disciplinary field of economic ontology, which is how economics deals with this question of what is and is not valuable, both in an anthropological and speculative sense. And among developers interested in systems that might recognize, sense, index, calculate value differently than current financial systems can, a reterritorialization of technologies of value and what they value has motivated their interest and aspirations. One question, in a sense, is how granular can it go? Bitcoin, for example, is of course an intrinsically deflationary currency, 21 million or so possible, and so the decimal space and of fractional exponential deflation is built into how it may sense or index anything. It's the opposite in a certain way of the exponential inflationary Zimbabwean dollar of the 1 trillion token that you may see here. But as such, as a bank or a token of value, it implies its own, not only as something that's capacity to abstract other things into itself, but it implies immediately its own economies of self-abstraction as an asset. And so as it's suggested that Amazon may soon accept Bitcoin, given the recent price trends in that particular token, it may do so less as a new way to, a path towards more liquidity for transactions, but as a way to consolidate capital. That is, the deflationary exchange rate per fiat currency means that 20 euro book that they exchange to you for 20 euros this month may be that the Bitcoin that you paid for it would be worth 50 euros next month. And so simply accepting it as a way of aggregating value in this way. The result is then less, as I say, a new payment option than an arbitrage between wholesale value of goods now and the value of the asset that they traded for those goods tomorrow. And indeed, the Amazon stock may go up, as is thought, based on the perceived value of the number of coins that the company amasses as holdings, as much as the value of the coin goes up or has already gone up in anticipation of this new liquidity. Okay, so now abstracting the coin from the chain for a moment, any revolutionary function of the technology, and perhaps that's far too strong of a word, but any sort of new functions of the technology would come, of course, from that traditional hotbed of romantic subversion, accounting. Accounting is among the first forms of writing, and as the fundamental its fundamental tracing function persists. Just as language articulates an ontology of what is nameable, accounting does an ontology of what counts. And in this, accounting has always been, at least in this way, a form of distributed, automated sensing of value, as defined by its own institutional cultural protocols, and for the indexing and calculation of that value. More imaginatively conceived, accounting has always been a kind of AI, one that generates institutional forms and which bends institutional forms towards its own sensory functions so that what they do might count. So one tension then may be between, as it is for all accounting systems, may be between the categorical and the universal. That is, any capacity for abstraction, as we've been discussing, the capacity for abstraction of any one thing is the extent to which it might be transposed for anything else, or anything else of the same category. And so according to this generic registration of token value, this becomes the terms of how abstract the abstraction might be. And that is, the things that are sensed according to the transaction for things that are sensed according to the protocols of a certain kind of category. So for generally accepting accounting principles, any event or asset is convertible to some common exchange abstraction, $1, euro, yuan, whatever, but not before passing through the categorical filters that define legal relationships, input and output, profits and loss, and so forth. And so perhaps we would come to see that the current proliferation of tokens, of micro-tokens of various sorts, are sort of attempts to try to define very specific functions for the transaction that are in fact more granular and specific, each of which, of course, is probably convertible to ether and with fixed contractual terms. We may see these in a way as a kind of early structural attempt to build the particular and the categorical into the universal and the generic abstraction that the currency provides. Categorization then is attached not only to the transaction, but to the token itself that initiates it. Metadata as imminent accounting. Now, so looking back then now at this exponential deflationary logic of the coin and tracing the decimalized value out to dozens of places to the right, as I showed, we may see something analogous to massively universal addressing systems, which is again why I put blockchains on this sort of layer, or perhaps an addressing system that is in itself capable of direct calculation. And so, as is often noted, IPv6, for example, is a 128-bit address string, which allows sort of theoretical possibility of 10 to the 23 internet addresses per person, questioning the ultimate granularity of addressable things and events as such. It does so by nominating that entity as a site to which and from which information may flow. And now, the sensibility then, the capacity for an accounting system and the tokens it relies on to sense value as it's directed to do so, according to, on this side, an exponential deflationary currency, such as Bitcoin, that is structured, is that the structured abstracted accountable value through which that transaction can be made is then also a kind of information. So for IP addresses, structured information is the function about which or through which the accountable value must pass, information standing in for value. For Bitcoin, basically, it's value standing in for information. And in fact, which is finally the metaphor for the other is a matter of some debate. And it's the extreme granularity then of the capacity for abstraction that makes such systems into a kind of ontology machines. They may sense, index, calculate, store, represent, and or mediate the world according to multiple cognitively coherent frameworks, any of which may be recognizable as something valuable or addressable, or valuable and addressable or not, or may assign gradient value to it and assemble an autocatalytic economy accordingly. And in this, the generic enables the particular, as there may not be one of these such economies, but several, multiples, millions, with each of which with a certain unsettled corresponding terms of translation among the others, a bit like languages, more than national currencies. And as for the bubbleliciousness of this all, and our inevitable reference to tulips, the 1920s, the dot-com bubble, and so forth, the collapse may in fact prove out. It may be in fact the case, but not because most of the people issuing such announcements, what pejoratively called non-holders, that they understand something deeper about the blockchain than the holders, but rather because they do not. It's worth remembering that the GAFA stack, plus Microsoft, let's say, of those, only Amazon was a dot-com company. The others appeared pre-internet or post-dot-com crash. The lesson being then that either that the crypto we have now is not the crypto we will have later, but that the blockchain as a model nevertheless may remain. The dot-com tulips vanished, but the web as a whole certainly did not. So, what coins flourish, what tokens work, what tokens can enforce their ontology and scale is certainly an open question, one that first begs what flourish means in this context if we take these as technologies of an economic ontology. It's a much longer discussion, of course, to be had, but one that I think lines up correspondingly with this riff about the multipolar hemispherical stacks that I described earlier. Because one of the things that we're seeing now, we're considering is the possibility that Russia and China, for example, succeed in launching state-backed cryptocurrencies, which may or may not be tradable with other currencies, or even with their own, which certainly we don't know at this point. Or at least they decide that a certain kind of controllable currency, or at least we understand that a certain kind of controllable currency within this realm reveals something fundamental about how governance works in the first place, and how it's dependent upon an economic ontology that must be, at least in some way, roughly isomorphic with its legal ontology. And so to modify one modifies the other. Okay, so this question then of value transposed to information and law, value, information, law, standing in for one another, playing a game of hide and seek with one another. Is Bitcoin going up against the dollar, or is the dollar going down against the Bitcoin? We'll see. Again, in terms of the stack model, I want to sort of suggest that make the sort of counterintuitive argument that instead of seeing blockchains in this way as just a technology of circumvention around state geographies and geometries, to anticipate rather the reterritorialization of them by bounded geographic hemispherical models, not the same as this Westphalian state, but as something that enables the ontologization of these interlocking quasi-sovereign cloud platforms to sense and index their own operations. Their borders, as said, track the circumference of data sensing and supporting apparatuses that may be quite, and of course, territorially, as we've seen quite eloquently explained, quite non-contiguous. The Australia and the UK, for example, being inside of a wider anglophonic stack. And it's the island, and also which is the island of Japan that has been in certain ways interesting, was receptive to exchange markets in ways that also sort of further its own history as its own sort of Galapagos status within the development of different kinds of technocultural solutions and cultures, and so forth. I mean, I should mention just quite briefly some students of mine that are in San Diego and in London that are working on a halal crypto, and I'll let you know I'll let you know what that actually means when they launch it, because I'm not sure myself, but we'll see when we get there. Or perhaps, as I say, perhaps what we see is this recuperation of some of the anarcho-libertarian fantasies for these systems fails, and the dark net, in all of its guises, becomes a permanent secondary layer of negative liberty, infusing the city layer at every turn and every nook and cranny. But again, sure, even that sort of involvement of accounting into the ontological turn, or vice versa, begs the question of this question of conversion between how this works between accounting and accountability. In a certain way, this question of accounting always falls on the more fundamental question of accountability and what and whom is accountable to whom and what. And so for some people, the allure of crypto is that it's perceived as it is perceived as a kind of its perceived antisocial quality. Trustlessness is held as an ideal, and the deregulation of external accountability is essentially the point. Autonomy in its most direct sense. And for others, an inverse interest may be most salient, may drive their own interest. They may see something else in that Rorschach ink blot, a way for an alternative understanding of what is valuable to scale into a functioning economics, and a different way of re-registering who and what is accountable to whom and what, and the way in which it might be properly accounted for and transacted. Instead of autonomy, a heaving interdependence. Now, I'll argue then that such designations are more than a forensic forum for a politics of representation and identity, or should be at least, but rather a means and ends, and that is not just a way in which the means and ends of the world making are sort of confused for one another, the world becoming once again a endless text requiring endless critique, but rather really an ontic machine by which the world reforms. The world is reformed in relation to the gravity of another economic cognition. At least that's what I would like to see in the Rorschach ink blot. I'm not sure that I do. But what I'd like to see then is that alternative economics becoming more a true representation. In fact, instead of being a sort of form of symbolic gesturing, that its aspirations, in fact, that the model of its representation becomes that which bends the world towards its grammars. This is what I mean by the ontic machine. For better or worse, we see, and double entry bookkeeping, as we saw, helped bring about the skyscraper after all. So, lastly, sort of close before I pass it on to sort of the conversation, a couple of things that we are working on. See San Diego and at Strelka and other sort of places around some of these things, really more as research projects in as well. One of the things about modeling of risk that's been raised are the questions of insurance. Insurance is even more boring than accounting, but insurance is one of the ways in which we have institutional forms of models of the future that in fact govern the present. And they do so through a quantification and perception of risk. And I think part of the problem of insurance models is that they have their own problems of invisible externalities. The types of real collectivized risk that enterprises may bring are not, in fact, accounted for within the insurance models, or certainly within insurance markets. But that's something that we can pay attention to actually understand the ways in which the real risks at a social level and economic level that enterprises may bring could be something that's, in fact, priced into the transaction. A reforming of the capitalist pricing problem, if you like. Again, a way in which the future might govern the present. We're interested then, of course, the ways of this sort of blurring of addressing and blockchains at the level of very, very low level forms of ubiquitous computation, and the ways in which this works, again, where the point by which synthetic computation and biosemiotics gets a little bit mixed up in interesting ways. So just sort of last couple of points. I hope it's clear that I really don't have a true believer's eye for this kind of stuff. It's also claimed that in terms of Bitcoin, for example, the Gini index, which is our measurement of income inequality within a country, if you look at the distribution of the allocations of Bitcoin in this as well, it's worse, if not similar to the absolute sort of worst despotic republics that we might want to sort of indicate in this way. And sort of I presume that worst case scenario in this one. But in a certain way, I also kind of want to be Satan's lawyer for the goods. I'm sorry, this term Satan's lawyer. I'll explain this very quickly. A few months ago, I was being interviewed by a Chinese journalist about something, and he kept interrupting me and saying, "I'm sorry to be Satan's lawyer, I don't mean Satan's lawyer over and over. And I finally had to ask, like, what do you mean by that? And I finally figured he meant devil's advocate. And I was, I was so happy with this discovery that I've sort of made it into my phrase. But the point really is this. And I have to thank Sandy Alexander, literature department at MIT, for this slide from a talk that she did there. The visible is in the eye of the beholder. And it really, this is the question of the kinds of patterns we would like to see in these systems and the kinds of things that we would like to see them to do. Is this a reopening of the question of an economic ontology? I think is an extremely productive project and discourse for its own sake, in its own sort of thing, in a way in which it might work. So very quickly, some of the things that we've been working on. There's a project at UCSD called Matrix.ai, which is an ether-based token that we've gone live. That's doing its distribution is live as well. That's based on CalcFlow and Nano1, which are calculus visualization and nano engineering modeling apps that we developed for Vive and for VR. And the idea is a kind of disintermediation of scientific research in which different types of works that people do are tokenized, and in fact they become that they receive the subsequent downstream value of what to do. Because I think we have some last year's Strelkanauts in the audience. I'll talk quickly about some of the projects we did last year. Sever. We were talking about some of the ways in which these value systems produce a kind of geographical operations in their own interest, and that these certain types of tokens. Sever is a token that gets more, is a location-based token that's more valuable as you get closer to magnetic North Pole. And it's meant to be sort of used around this Arctic Circle economy here, which is, of course, extremely transnational, and one that's becoming increasingly more populated. And this is the ways in which that the structure of a kind of localized structure of exchange may in fact allow for an intensification of the economies around here as well. And of course, this is all anticipation of the melting of the polar ice cap. So there's something intrinsically perverse about this project from the very beginning, which we're quite aware of. DOMA is another one which came out last year, which was what is, sorry? Slow down. I'm trying to let other people have a chance to talk too. Because I know the 15 minutes, I'm trying to be cognizant of my 15 minutes. Maybe I should forget. Okay. DOMA was also one, there was among now a kind of genre of blockchain-based real estate projects, of which there are several. What this one was really looking at was the Eastern European context, and I think took the question of trust and the ways in which the lack of trust in real estate markets and housing markets in this area is something that blockchains could actually remedy. And so instead of thinking of these as trustless systems, but rather as a more trusted system, was the ways in which it would sort of work. And so that those who were people who were, and there's a number of sort of statistics we can go into, has to do with this strange asymmetries between the how much it costs to rent a place versus the extraordinary price it would cost to buy would actually allow for a development of equity in ways in which it wouldn't have worked before. Fee is a project that was also done by our Strelka alumni that was taking this question of the energy that's necessary to produce the token as both as a sort of a perverse pathology of the tokenization itself, but also as a recognition that we are a little bit closer to an energy-based currency, and that if you're going to have a general currency based on anything, that the energy cost of its own production is certainly better referent than magic rocks of gold, for example. And so the question, this whole system was kind of built into this as well. And so what it allows for is the production of nodes of, in this case, renewable energies that produce the actual tokens. And so instead of incentivizing people to put servers on the mine to produce the tokens, you're incentivizing them to produce the energy which produces the token. And so it in fact becomes a kind of micro-incentivization for these kinds of networks. And there's a whole AI chatbot we built on this as well. And also slide. Also make a quick shout out to foam.space, which was a project that I've known for quite some time, which is really looking at an addressing layer, looking at blockchains as an addressing system within cities, as an open location protocol. And a couple of one of our Strelka alumni is now working with this as well. Lastly, I'll just say, and again, I want to make sure that we're the other time. The aspect of this that I'm really least interested in around the tokens, where we have these sort of entities that have this symbolic value, and they work in this as well, is the ways in which that the interest really is the part I'm least interested in is their symbolic quality, and that the idea of blockchains as a kind of repository for gesture, repository for acts of public virtuousness, is, to me, the least interesting aspect of it in certain ways. Realizing that we, as a species, have a kind of fetishization for seashells and tokens and this as well. I'm really much more interested in the structural level of this as well, and what the kinds of transformations it would make around this as well. And so some things to say about the kind, speaking of rituals and ceremonies, the kinds that we might expect in anticipation of the last coin being mined, and all the rest of this as well. So I want to sort of stop here as well. This question, I think one of the things that's raised by this is this question, again, this movement between information, energy, and value, and the transposition of this and the kinds of institutional systems that we produce by which one metaphorizes each other or literally stands in for one another, is exactly, I think, the kinds of design questions and political questions that we want to be asking. The question, how it is that we would do so, that one may be positioned in such a way that it incentivizes or produces, or more properly said, enforces the kinds of outcomes that we would want. In many ways, the kind of energy systems that our societies are based on drive the social relations that we would have between them. And so, anyway, there's much more to talk about this as well, but I want to sort of stop there. So thanks for your time.
Let me tell you a story. Story about the city of cities, Paris, capital of the 19th century. On March 13, 1856, a Thursday, Baudelaire was woken at 5 in the morning by a huge noise interrupting his dream quest. In the dream, the French poet who began his literary career championing the paintings of Eugène Delacroix arrives at a brothel, a whorehouse. Immediately after ringing, he realizes he's naked, his prick hanging out of his pants. Don't worry, I promise there'll be no live performance on stage. He feels it is indecent to present himself this way, even in a place such as this. Not so much because his manhood is there for all to see, but because he's barefoot, too poor to get proper trousers and a pair of shoes. He gets in and offers the madam of this great house of prostitution a gift, a token, a first edition of his recent translation of Edgar Allan Poe's extraordinary tales. Better than a one card. Soon he finds himself, and I quote him, in immense galleries adjoining, poorly lit, like the reading rooms of old or squalid gambling dens. Curious and curiouser, the brothel is also a museum, showcasing the advancements of medicine, science, and progress. Even curiouser, he says, a brothel, a museum, and a place financed for a speculation by the 19th century equivalent of what we would now call a media and investment conglomerate. So the brothel museum looked in the dream like a huge, boundless, mnemotechnical architecture, not an edifice, but a stack. Inside it, open up a network of interconnected passages with no exit, like the European Union, according to maniac Brexiteers. This is the architecture of the new. According to Benjamin, the pulsating neural system of lights and goods in which the phantasmagoria of Paris was condensed, while Paris, in turn, was a miniature of the entire planet that would unfold from that moment until this very day and beyond. Following the mainstream reading of Baudelaire and Walter Benjamin, Roberto Calazzo interprets the Brothel Museum as a dreamlike paralogism of the shopping galleries that populated the landscape of the capitals of the world from then onwards. This is, of course, contextually correct. It is appropriate. But let me propose it would be more fitting to our purposes today to see in this huge mnemotechnical architecture, this network, an early image of what Benjamin Bratton has aptly termed the stack, and more specifically, an image of the financial markets of the present and the near future. Indeed, the first characteristic of the Brothel Museum is that of used things, consumed and worn out by use, as Baudelaire puts it, absorbed and subsumed within something else, stacked. Time is perceived, Baudelaire says, not merely through ruins and monuments, but through its corrosive action, the corrosive action of time that sweeps over all things, even the new. But, crucially, in this gambling den, in this house of prostitution, one could arguably bet for or against the future value of all things, beginning with the vanquished bodies of the women therein, but also the promises implicit in the act of gift-giving to the madam of the house and the contracts set up between prostitutes and clients. Yes, I'm comparing the near-futuristic computer-driven world of derivatives trading with a house of prostitution that's also a museum of science and progress, as per Baudelaire's dream. Now let me invite you not to dismiss this provocation as tactless or immoral, but to think of the vanquished and expropriated bodies of the prostitutes as the underliers, which can be sold for a price. Taking account of the corrosive force of time's passage, or predicting its effects, the madam or a pimp may put a value on the bodies of the whores trading sex, in a sense carved up and separated from the underlying body, dismembered, the underlier, dismembered like the bodies of the disappeared and the tortured victims of genocidal plans, now turned into an option that could itself be priced and sold. Wasn't this precisely what Herbert Marcuse and his Frankfurt colleagues had in mind when they proposed to the US prosecutorial team that they should pursue the economic cause, the civilian profiteers behind the genocidal plans executed by the Nazi leadership during the war in the course of the 1945-46 Nuremberg trials? Isn't this precisely the blind spot of the 1948 Universal Declaration of Human Rights and of today's urge to depoliticize human rights? Returning to Baudelaire's dream, if someone can put a value on the future fate of the underlying bodies working in the brothel museum, on disembodied sex, on the debt incurred by the women towards their pimp or madam, taken as a contingent claim, then somebody else, a future client, perhaps Baudelaire himself or his futuristic computerized avatar, could call upon that option to buy sex or debt or whatever can be divided, granulated, and separated from the vanquished body of the prostitutes. If so, the latter can no longer they can no longer be seen as individuals, the undivided legal subjects of rights conjured by the dream of progress and enlightenment, but as individuals whose cut-up bits can be recombined, bundled, tokenized, leveraged, and bet for or against by those with the relative security, the capital, the liquidity to do so. In Baudelaire's dream, the walls of the brothel museum were covered up with images, lines, and mysterious Egyptian figures. These were a kind of a primer of an almost hieroglyphic language, he says, which made him feel ever more intimidated. Isn't this precisely how most of us feel when confronted by the almost hieroglyphic language of finance? The jargon of put, call, option, derivatives, swaps, and synthetic CDOs? No wonder we worship the risk-taming beasts of Wall Street and Silicon Valley or the City of London, the totem-named masters of the speculative and digital market universe, bulls, bears, vultures, vampires, as if they were pharaohs or a priesthood in possession of some esoteric knowledge. We stand before them and their institutions, also their legal and political institutions, fittingly housed in the brothel museum-like Gothic cathedrals of New York City or the City of London, connected underwater to the Caribbean. Ooh, the pirates, colonization coming back in awe. The same way lay people stood before the Latin-speaking priesthood and the magnificent Gothic cathedrals before the Reformation. Back then, the carved souls of vanquished bodies were sold in the market of indulgences. Add up computers, stochastic models, predictive algorithms, and the carving up and data mining of your innermost bits, and you realize the current situation isn't that different. Our innermost risk potential, carved like cut-up words from a lost language, a silenced voice, a broken promise, or a disappeared body, can be bundled and bet against. Where do these bodies go? How do we count them, make them count, matter? Perhaps these bits can also be recombined by near-future forensic investigators of human rights violations or artists creating objects that stand for the silenced and the dead without absorbing them, but rather in ritual-like mourning work, performatively in search of a different political spirituality and a new way of counting. One that may harness the wealth-creating capacities of derivative logics, their plasmatic electricity, their mana, retroactively legitimating a structure that isn't already coded as male, white, masterful, patriarchal. This would be a new way of adding up the silenced and the dead, like the detectives in David Simon's acclaimed TV series, The Wire.
So a few brief words on what I call the derivative condition or derivative logics. I've spoken a few things about this in the switches section, so I'm not going to be too kind of detailed on that, because I want to go through a few examples of infrastructure, states, deregulation, which is actually nothing else but self-regulation of these markets, and then talk a bit about tokenization. The Technosphere's Unbound release is not simply an accelerated expansion, but a swing, a wave, a contingent move from the beginning. As a manifestation of volatility that performatively collects demands and often co-opts the relations of what it enunciates, it follows a derivative logic. The derivative, I would argue, is sort of the first metadata in a technological sense. It is the metadata of uncertainty, the firstborn risk that at instance proliferates into all expectations of what can possibly be conceived. Since 1987, that is, since the big crash that happened in October of that year, the derivative is the metadata, as metadata has actually really taken over. Instead of being replaced by another logic, it was re-engineered and it was turned around. So the way it is used was kind of like switched. It was not anymore that the underlying asset, the prostitute or whatever you want to call it, was the actual point of reference from where you would look at volatility, which would be the first derivative, and then to the variance of the volatility, which would be the second derivative, but it was turned around. You call that dynamic hedging or implied volatility, and that is actually what the derivatives market really started to sweep across all markets and became the paradigmatic form of trading. Now what happens is that the derivatives actually are priced and are traded by themselves and not just are an indicator. So the metadata is the actual traded object that then talks about the underlying. So from that moment on, the underlying asset becomes secondary to volatility, to the random shift, jump, swings, or the lack thereof. What is the token in this configuration? And I think, interestingly, the token of this regime is nothing else than money proper, money itself, that stands in for anything fungible, anything that can be traded, anything that can be commodified, can be exchanged. And if you extend that, and you, for example, think of Klosowski's living money, you see how far that moves, how much it also includes the body, and I think you referenced that in your vignette very beautifully. So, but the derivative is not a principle per se. It is a move. It is the move of moves, one could say. The logic of escalation that creates jumps without swinging, that speaks within the swing. It consolidates matter, and in its own form data, without being matter, so data. It is metadata of an underlying, at the same time, the virtual epiphany of the very potentials. While what matter is to accelerate in the technosphere, it's all about acceleration in the beginning, and with every leap, the new speed becomes the new normal. The derivative as a technology, one could call it, because it's more and more becoming an automated algorithmic force of production of knowledge, so kind of tech knowledge, permeates all manifestations, even those that haven't yet manifested, and encapsulates the linearity of speed into multifarious movements of non-directional, non-linear, fleeting entanglements. In this derivative condition, where solids are prone to drift, power shifts from representational to performative speech. That is why we cannot read it, why it doesn't communicate in images, but also its language is something that really doesn't speak to anyone. It is not just a hidden language, not something that is arcane. I think it's a language that is built to deliver process, to deliver performance, so to say. So the put, the long, the short, the call, all that is really about the performative moment, the change, the switch, the recalibration within these processes. It evokes an all-train of the relative, of the precarious and the contingent. The incessantly recalibrated cascades of derivatives generated on derivatives from a volatile grid of anticipation in which bounding and unbounding happen at liquid moments. As moments of the nearest future, these liquidities annihilate the present, annihilate the bond between past, present, and future. Confronted with the creation of extreme volatility as a scheme to leverage power and profit, and leverage, I think, is a very crucial, one could even say tool in this respect, as a technique or even more. In the switches section, I referred to a reading of leverage that I think we should not forget when we speak about depth, which we very often do, that there is another depth. There is a depth that opens to the future, that makes the future a productive form that you can recalibrate, that you can produce, in which you can hatch your bets during that time, in which you can externalize specific risks. And all that is, there is a word for that, and this is leverage. So if you look at this in the sense of a social form, we could actually really delineate a class system of our contemporary age, where you have the different tiers of leverage classes, debt classes, and those which are not even in debt. Right? So leverage is the other side, the opening, the optionality side of debt, which I think we need to take into account. Within this situation with extreme volatility, when this, as we see today in many, many instances, where escalation becomes a form of production, a form of being first, so to say, in media and in politics, with that, this creation of volatility, if that becomes extreme, what happens is that the old paradigm that we're all used to, kind of like how things are measured and evaluated, that is the probability paradigm, snaps. Normal distribution is speechless in the mob phase of fat tail events. Unbounding what matters and unbounding matter at the same time, the derivative paradigm introduces a non-order of contingency, an instance at which we can learn how to leverage the optionality ingrained in the derivative instead of attempting to hedge what cannot be secured anyways, and understand volatility as a techne, as a performative risk practice by which we might unleash potentialities of present futures. I think that is the way that we should look at this and take it forward by somehow affirming it to be able to kind of develop new forms of practices. Because in a sense, if you use the word hedging, what is included in this is the word insurance, of course. But it's a form of reinsurance that is versatile, that is open, that can be adapted in different instances. So the question that interests me, where is the leverage that allows us to not only survive, but to serve these waves of volatility, to create the performative flow of a future saturated in presence, because what gets lost if the future is kind of annihilated through old obligations of debt is actually the present where it is born. And in the instance of our theme today, what is the role of the token in this infrastructure, in this stateless state, the shifting maze of interconnections and disconnections that the derivative spawns, recalibrates, and dissolves incessantly? I think I need a drink. I'm totally dry, sorry. Structure. What you see here is a trading floor, and I think everyone knows what a trading floor is. This is a newer form, and if you look at finance, you could kind of define it into different forms of profit centers that change over time. And the old original one, of course, are the traders, but these kind of classic traders that would stay in the trading pit that Ilya Yash was talking about on Wednesday and Thursday. That he believes in the people that kind of exchange, that are matter, that are body, that together perform what the market is, so to say. This is the next step, that this is the first change of the profit center from traders to quants, to quantitative analysts. The people that come from Ivy League schools, from MIT, from the best mathematical and physics institutions, and work for huge investment banks, or, if they're really smart, start their own hedge funds. This is the largest ever trading floor, which is UBS, Swiss bank, but it's in Stamford, Connecticut, very near to New York. It's a center of hedge funds and investment bank trading. But if you look at this, it existed for roughly 6 years, I would believe. Now it's an empty hall. There's nothing. Old cars are parked in it. So this kind of form of infrastructure was massive, was extremely profitable, of course, but today it's history. With it, there is this term, the Bloomberg terminal, that maybe also some of you might have heard, which is a split screen that opens into the space, as in finance they would call it, which is into the market, into the trading of derivatives, all sorts, or assets of all sorts, and commodities of all sorts. It always depends what kind of sector it more or less is. You can see there's quite a few of them, and the way that it kind of surrounds you, the way that it produces you as a trader, because in this instance, in this kind of world, the trader and the quant work together, right? Is something that I think Karin Knot-Cettina has shown quite nicely when she was interviewing traders, Swiss traders, in early 2000s. I'm not quite sure which year it was exactly, where these people speak about the being. So they don't say the market or whatever kind of market it is. So they speak about the being in which they are and which they are. So it becomes this hyper-identification. So the Bloomberg terminal is more or less a door through which you go, and then you're in this kind of game space, if you like. No? It's a little bit like in virtual games, where real players are also kind of like within that and identify with the surroundings. With the difference that the decisions done here don't stay in the game, but of course have enormous consequences in all kind of different worlds than just the financial one. That's another one. That's in a hedge fund. what I found interesting about this hedge fund is it's guys that are about 30 years old, listen to hip hop, are super cool, live in New York. What do? They share a flat. And it totally reminded me of the 80s, 90s New York art scene, where people would share flats to work, live, and party together. This is not dead, obviously. This has just kind of changed gentrification position, if you like, and it's now the new generation of young hedge fund guys that live that life and love it, of course. No? This is a change now to the next profit center. That profit center is the coders. So they kind of like replace the quants. This is when automation develops on a level where it completely overtakes the production of profits, where the amount of what you need to invest to what you get out is the most interesting. This is when hedge funds start to develop automated trading systems, when things happen like high-frequency trading, which I'm sure you've heard about, and I think we cannot talk too much about it. It would be too long to do that. But just to give you a few images on how this change happens. This is, I don't know if the video works, this is how trade in high-frequency trading works, meaning how it is faster than a so-called normal trade, how it can do that. Okay. Shut up. Should I say fuck? It would be a situation for that, no? Okay. Algorithmic trading structure. That's maybe one point I would like to stress before we go to the tokenization part, is that these are kind of like the most important trading venues worldwide. But actually it's the US that even until now is like the major player. It has 13 official venues, trading venues, but about 65 dark pools. You know? So you can see how intense the competition is. And that is something that has had enormous effects more recently, because you can imagine that, you know, in the developer world, so to say, which is a high-frequency trader world, this is hyper-competitive, and it's about latency. That means how fast you can be in relation to the material world, so to say. No? If you imagine that if people realize that this is a profit opportunity, how many will go into that world? A lot. No? So competition becomes more and more and more, which means that even for the old and the big players, and the smart players, it becomes more and more difficult to really produce profit in that situation. So what do you do? And that is where the next profit center kind of starts to develop. You have to find other ways of making profits if you can't do it with your normal kind of strategy. And if you know that in the US you have so many different exchanges, and you know that they are corporations themselves, which means that they need to produce profit, you realize that there is competition also between market centers. You know? So that means that they have to try to bring in volume. That means a lot of people that trade there. So what happens is that their incentive schemes start to happen, and the second thing is that more and more people from hedge funds or big banks start to buy up shares from market centers. So what you have is sort of developing information asymmetries between those that know how the exchange works and those who don't. You know? And that within finance, and I'm not talking about mom and pop investors, so to say. So what is happening now, and there's a whistleblower who I'm working together with personally, who won a case in that field, so this is evidenced, is what you call regulation arbitrage. You start using regulation or working against regulation because you know how it works, how you implement it, or how it has to be implemented, and by that you realize where there are kind of situations where the information crosses, or there are holes of information that you can exploit. When you also know that this is a very complex field, where it's very, very hard that someone catches you, especially because you have to prove every case very, very clearly, which means you have to have a lot of intense expertise to be able to go into that and really prove it. You can see that this is actually an interesting profit situation, which led to that next situation. That's what I mean with the change in the profit center, is that more and more regulators are buying hedge funds or buying themselves into hedge funds, and hedge funds buying market centers, because they know how it works. So the regulators now game the regulations. And this is a sort of game that is played because the normal possibility of making profits in that field, because of latency or speed, doesn't work anymore. I think it's highly interesting because it means that somehow this form of capitalism completely hit the wall, because it's proof that there is no equilibrium or anything like that. But for kind of producing profits for owners, etc., we have to use all kinds of methods, whatever the methods are. Is it so dry, or is it only me? So this was like where infrastructure goes today and how this develops. Something else. Now this is, of course, this other side of finance that's been developing from a purely technological position. And you can see this is a screenshot from just a few days ago, like how also capitalized or how strongly incentivized trading in blockchains has become. It's not like in the beginning, of course, that some scientists and some geeks were in that field. Now it's like the new idea, the new possibility for investing. And this is, and you find hundreds of movies where people talk about like how they made millions, etc., etc. So it's become sort of a penny stock, which means a speculative object. I'm just showing this. I want to say something else, actually. But I'm just showing this kind of like these differences between how a normal trade works and how blockchain work. But what I think what changes here with the tokenization is when we talked about the token before as actually being money in derivative markets, what happens here is what connects the human and the non-human in the algorithmic technosphere. Within that world is the hash. And as it is not reversible, and has to be created each time, it is sort of a quant legal entity. It's a technopolitical individual. The token could be interpreted as a form of labor, a decentralized, automated labor, high-tech in its capability to boil down various occupations and their specific temporalities and values into a flash-produced digital simulacrum or counter-image of what is even beyond and outside labor, the potentia, to use a Spinoza term, of becoming. The token identifies the being in a verifiable moment, which it, however, doesn't normalize. That is, it doesn't give it an immutable, lasting identity. Rather, the token constitutes versatile and variable identification within a performative realm, in which representation is not only completely detached from what and who it represents, but in excess opens a parallel plane of subjectivity to which the physical subject has no access. What protects identity at the same time annihilates it. Within the systemic recalibrations, the token is the individual, which for a while now has been embodied in the corporation and not in the subject as such. Just going on. This is like hashing works. This change corresponds to the sea change that occurred with the derivatives after 1987. Re-engineered the operations altered their poles from the underlying asset at center to the derivative at center. This is called dynamic hatching and employed volatility, as I said before, and means that the metadata of volatility and variance became the actual data traded. The derivative only then became a market proper, and from then on, finance turned to price of the derivative to calculate the price of the asset, and not the other way around. But in this takeover, the polarity switched as well, from hatching risk to producing risk, from fearing volatility to creating volatility as competitive advantage, in which noise becomes the master of information. And what comes to fruition is the performative quality of the derivative as a new speech of power. The token, we can say, is the derivative, the metadata of the underlying identity, and represents it in a performative way within the ecosphere. But as such, it takes over the functions of the asset, and we are assets of our own making and of those investing in and speculating on us, and produces a new subject and a new subjectification that is outside the body, even though digitally incorporating in the body. The biotoken is the derivative of the former subject that in turn assumes subject status, amongst other reasons because we're dealing here with contracts and contractual questions. The derivative is not only a technology of the future, it is in any instance a contract in a diversity of meanings, and especially one of trust as future expectation. However, I'm critical of the general explanation for the thrust and direction these schemes are based on, which is the promise. Rather, I would argue, promise is a linguistic persuasion device. Both the contractual and conceptual cores come through much more clearly in the lesser-known other term for the derivative, the contingent claim, that has no state and no states. Thank you.